Concerns around credit quality have had investors looking at the health of the U.S. regional banks. Are these just isolated incidents, or are there more systemic risks out there? Joining us now to discuss is Justin Kim, VP and Director of Investment Grade Credit Research Group, TD Asset Management. Justin, great to have you with us. This story percolated a couple weeks ago, then disappeared, at least from the media headlines, pretty quick. Remind us why we're thinking about regional banks right now.
Sure. So, as you noted recently, the regional banks saw some notable pressure on their stock prices, and that was really stemming from concerns around three commercial loans. I'll briefly describe them. One was a company that provides auto loans to lower income consumers. That company is called Tricolor. Another was an auto parts supplier named First Brands. And the third was a commercial real estate investment fund. So what's interesting about those loans is that they all fall under a category of loans called non-depository financial institutions, which are basically credit providers or loan providers that are not banks. So bank lending to the NDFIs grew pretty rapidly during the past decade and now account for a pretty sizable portion of the banking sector loans at around 13%.
That's a big increase over that period of time for these non-depository financial institutions. What led to that increase?
So there's actually a couple of powerful drivers for that growth, or there were. The first being stricter bank regulations. So after the 2008 financial crisis, regulators were obviously concerned, and they placed much stricter requirements on banks to make them safer. So those measures included higher capital requirements and liquidity requirements, among other measures. The one unintended consequence of all that was that it made loans or lending less profitable for banks. So this opened the door for non-bank lenders like private credit to fill the gap. The second big driver was the prolonged period of low interest rates that we saw following the great financial crisis. So with lower rates, a lot of institutional investors were looking for products with higher yield, which was provided by the private credit and other structured products. And banks began lending to these alternative credit providers because it offered better diversification and required a lower capital reserves compared to directly lending to these underlying borrowers. So essentially, banks found it more efficient to lend to the NDFIs, which then lend their money or funds to businesses and other borrowers.
So we start to understand how the ecosystem works. Should we then be concerned about systemic risk?
The short answer is not really. So the three NDFI losses were unique to specific cases rather than indicating a broader systemic issue. Recall those losses were in three different sectors or subsectors. But one common thread was alleged fraud that the banks did not detect in time. First, I want to clarify that banks spend an enormous amount of resources to detect fraud and on risk management, but fraud, by definition, isn't entirely preventable. That said, you could make the argument that fraud risk can be cyclical. So in periods of fairly stable economic stability that we saw during more than the past decade, and also intense competition, there can be periods where due diligence by banks can become less vigilant than usual. So during the most recent earnings calls, bank CEOs acknowledged these risks, but emphasized that their own loan underwriting standards remain very robust. So what should we expect in the coming months? Risk departments will be combing through their exposures more closely. And I actually wouldn't be surprised to see additional questionable situations, but the expectation is that they will be manageable and not widespread.
Man, so how, like you said, obviously the industry works to contain risk. You cannot completely eliminate risk. That's the world that we live in. But you do think it will be manageable.
Absolutely. And I say that with some level of confidence, and that's supported by strong bank results that we've been seeing. So in the most recent quarter, asset quality of loans remained robust, with stabilizing losses that are showing signs of further improvement. Going into the earnings season, there was actually greater focus on the health of the consumer, and that's due to the slowdown in new hirings and also some signs of percolating inflation and also tariff-related risks. However, we saw declining credit card losses, and credit cards tend to be one of the first areas where you see consumer stress. While I would say there are still pockets of risk, especially in the lower income consumer segments, we didn't see evidence of widening losses or systemic contagion. Also, bank earnings and capital levels remain very robust, which will help episodes of unexpected spikes in loan losses. To maybe sum it up here, the regional banks were in the headlines due to the NDFI losses, and we still do need to keep an eye out on certain segments, but the initial market reaction was overblown. And beyond the headlines, the earning results were robust, and their balance sheet remained solid overall. That said, you still need to do your homework to see which banks offer the best risk reward.